Hello, everyone. This is Justin Smythe from nextbigtrade.com. This is your weekly index review for December 29th, 2023. During a holiday shortened week this week and the last trading week of the year, the S&P 500 was up slightly for the week. And you can see the volume was actually the lowest weekly trading volume that has been seen all year in 2023, even lower than the volume that occurred during the Thanksgiving holiday week. Now, the S&P 500 is 9 weeks into its current rally, and as I've discussed in the newsletter, starting with last week's issue and again into this week's issue, there's a lot of warning signs in the current market. A lot of the criteria that's discussed in the timing model document when you're looking at timing highs in a existing uptrend is starting to fall into place, and that's a warning that the market could be ready to roll over into its next correction. So at this point, we've had a monster rally coming out of the late October lows. There's been some big gains in a few different leading sectors, notably cryptocurrency stocks. But now, unless a new leading sector kind of comes up quickly in 2024, more than likely we are going to be getting ready to finally roll over into that next correction. And as I discussed last week, a logical place the market might decide to pull back to would be around the 50-day moving average, which is the 10-week moving average, which is the red line on this chart. That would bring the market back to a former area that it consolidated at around the end of November. And you can see how volume kind of tapered off during the end of this latest rally, again with the holiday trading, but without a lot of power behind the rally and getting this late in an extended rally. That's just another indicator that the market might be getting ready to roll over here. And we'll see what happens if the market does pull back. It gets into an area where it should bounce from. It also has former resistance levels from the previous uptrend that it can kind of fall back into as well. So this looks like a very logical place for a pullback. Looking at a couple more of the major indices, you can see the NASDAQ 100 was up just slightly for the week as well, underperformed the S&P 500. The same thing with the NASDAQ Composite. And then the small cap indices were actually down this week. The Russell 2000 was down almost 0.5% this week. And if you look at the daily chart of the Russell 2000, you can see how volume has kind of come into the downside now over the last couple of weeks. You've got some heavy volume distribution, including what happened on Friday. The market closed at the lows of the day on Friday, down over 1.5%. The gap coming out of the Fed news is a logical area, obviously, to pull back to, and even back to the 50-day moving average. So again, there's a lot of areas the market could pull back to easily and kind of digest the recent rally. The Russell 2000 Growth Index was down last week as well. And now turning to breadth, again, another portion of the timing model that really gives you a gauge of where the entire market is, and basically you want to be buying stocks when breadth is oversold, because that means that there's more stocks that have the potential to move up and power a market rally higher. And then when breadth gets overbought, that means most stocks are above the 50-day moving average in this indicator, and that basically means that most stocks have now had a rally and they are more vulnerable to a pullback. And when the overall market is not in position to help power individual stocks higher, that makes even the best stocks vulnerable to a pullback. So at this point, the S&P 500 has now had overbought breadth for basically 5 weeks now, which is a pretty extended period of time. You can see that in previous rallies. For example, what happened at the end of July, we weren't as overbought for an extended period of time as we are now. And again, just makes the market more vulnerable to a pullback. So heading into 2024, this is a very extended market. If you look at the VIX indicator, it's still holding above support that it's kind of created since the end of November. It did pull back this week, but if it does ramp up heading into 2024, that would be another indicator that we're getting the correction that we haven't had for a while now. Watch for a close above the 10-week moving average. That's really the indicator that separates when the market's in a correction, like in September and October, versus when it's in a uptrend, which is what we've had recently. Finally, turning to the small cap or the inverse ETFs, this is the bearish small cap inverse ETF TZA. I discussed this in the newsletter, but there's some big volume coming into this ETF on the upside, like upside volume that we haven't seen really since the previous correction, and where it ended around, or actually where it started around the late July, early August time frame. You can see a bunch of volume coming in here. Now we've got some massive volume coming in. And again, we've got some gaps that we could probably rally back to and close off, on a rally in these bear ETFs. So big time volume coming in. Perhaps institutions are hedging an upcoming correction. Same thing with the UVXY ETF, which is bullish on the VIX. You can see some massive volume coming in over the last couple of weeks, including what happened on Friday. So overall, conditions are just not good to support individual leading stocks at this point because the market's vulnerable to a correction. I think the best strategy really is just to let the correction play out. This requires perhaps multiple weeks of patience to kind of see how the market trades as we start 2024. And then once the correction moves through the market, new leading sectors should emerge, and that will provide the next big opportunity as we move into 2024. But really at this point, patience is required to see how the market handles things as the market opens next year, and whether the market's starting to move directly into that correction that's probably upcoming.